Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. It's Quincy Krosby. This is The Talking Point. It's Tuesday morning, May 30th. And this morning, as the market has opened, Nvidia has joined the $1 trillion club in terms of its market cap. Amazing. This report that came out of Nvidia last week set the market, moving in the direction of obviously the NASDAQ and going into the large tech names. But Nvidia underpinning a theme that, by the way, has been in place for many years. It's just that it is elevated in terms of its importance and where companies want to go. And that is in the artificial intelligence area. Many have said, well, why is this new? It's new, only because it is becoming more and more important, and it will be used in terms of development towards cutting costs for companies. So it's not just when we look at the business cycle, and I'm not looking in other areas, but just within the business cycle, the goal is to create an intelligence that obviously can take the place of humans in the in terms of cost cutting. So that's what they're looking for. Customer service is an area, for example. But I could go on and on. And when I look at our own market, artificial intelligence is extremely smart in the form of the algorithms, which when I started in this industry, we didn't have much of it, and it has become a, what shall I say, high frequency trading based on algorithms, 40 to 50, sometimes 60% of daily market volume. Reading before the human trader can even get a grasp of what was released in terms of a statement, can read it very quickly. In terms of speaking, they pick up words and move the markets accordingly. So this is just a deeper and deeper move into artificial intelligence. And NVIDIA, that many just always think of in terms of the gaming, has moved into the chips that are very, very quick, very, commensurate and in concert with exactly where artificial intelligence research and development is poised to move over the next number of years. So I want to point that out. You'll see it in all the headlines, joining the $1 trillion club. This week is obviously a very important week. Wednesday, that's tomorrow, seeing whether or not they can get the vote. It looks as if they're going to get the vote to get the debt ceiling deal done. I was actually heartened when I heard Speaker of the House, Kevin McCarthy, come out and say last week that, there are going to be a lot of unhappy people with the deal as they move closer to getting a deal. And I thought that's very good news, because it means that they were doing the necessary work, the horse trading that goes on to get a deal done. Either you're going to have everyone happy, or you're going to have everyone unhappy. And not everyone is unhappy. Everyone is, I think, the middle of the road of both parties, very grateful that a deal has been crafted to get it done. It is the wings on the Republican side and on the Democratic side that remain very unhappy with this deal. But in order to move forward, they were going to have to do what they had to do. And that is, again, that's the political process at work. Now, the question is, if they have an easy time of it to get the party whips out there, making sure they have the vote. And from what I understand, the party whips were busy over the weekend making sure that they will get the votes, and it will probably go to vote tomorrow, Wednesday. So that was good news for the market. This week, and one thing I do want to say before I move over to this week, last week, the PCE, Personal Consumption Expenditures Index report that came out last week, a touch hotter than the market would like, but I don't know if it's enough to get the Fed to telegraph that they'd like to see a rate hike on June 14th. Right now, as I do this call, the rhetoric from the Fed seems to be an idea that they'll wait, see what happens with the credit markets, and also with the debt ceiling debate, because if it doesn't go through, for whatever reason, I can't see them raising rates on June 14th. The other issue with the debt ceiling is that there is going to be liquidity, and no one knows by how much, a liquidity crunch in the market, as they're going to have to go out and into the Treasury market when this is over. So that may be another reason that they wait for the July meeting, perhaps. The other aspect is just the data releases. So yes, the PCE slightly hotter than they would like, but kind of in consensus where it is. But you still have inflation up over 4%, which is not what they want. And then this week, we are going to have a number of readings that are going to be important for the Fed to make up its mind. Now, the one is the ISM manufacturing report, the Institute for Supply Management manufacturing report that's coming out this week. And the reason this is important is the following. It comes from the purchasing managers. It's a major report, and it has a direct positive correlation with the market. For example, even though this week we'll get the manufacturing report, next week we'll get the service sector report. But what we know historically is that if the manufacturing headline is 43, 44, it usually leads to a recession. It usually is the early backdrop of a recession brewing. Good news is it has ticked up. Is it in expansion territory? No, but it is ticking up, and that's good news. But what we're going to pay attention to is, in that report that comes out this week, is the prices paid, because you don't want those prices paid climbing higher. That is recessionary. And particularly when you have numbers that show weakness in terms of new orders and prices paid higher, that's a stagflationary reading, because the stag is not doing well, the economy's slow, orders down, employment expectations down, and yet you're paying more for the materials that you're buying. That's something you don't want. It is shifting to a better scenario, and we want to make sure that the report that we get this week actually reflects that. So that's extremely important, and we'll pay attention. Also, this week is a busy week for employment, right? We'll get the ADP report tomorrow, and that is the private sector hiring. And what we want to see there is, where are jobs being created, how many jobs are being created, and also any sense of wages. So that's on tomorrow, Wednesday. But then on Friday is the big report that the market's waiting for. And what do we want to see there is wages coming down. You don't want to see wages climbing higher, because, again, companies will try to pass along those wages to the ultimate buyer, whether it's a retail buyer or whether it is a business buyer. Now, keep in mind, we are paying the higher prices as consumers. All of the data indicate that. And one of the things the Fed is concerned about is that we, the consumer, responsible for 70% of GDP, by the way, consumer spending, that we're entrenching in our psychology higher prices. That is not a good thing, because what they look for is all of us basically saying, whoa, I'm not paying that. I'm just going to wait. I'm going to wait it out, because that's crazy. I don't want to pay those higher prices. So far, we're not doing that, and the Fed does not want to see that happen. Again, it comes into this notion that higher prices are becoming entrenched. So in any event, what we want to see is a labor market that's still solid, that the unemployment rate is not skyrocketing by any means, but that wages are coming down, beginning to come down. I also want to add that prices paid, in other reports that we've received, those prices paid are beginning to inch lower. That's very good news. Also this week, we will get the Beige Book. that is that anecdotal reports from all of the Federal Reserve bank territories. It's pretty up to date, and that's why we like it, about how they see the economy. What do the banks see? What do the small business owners see? What do the large corporations in the respective territories? What do they see? And they come out with that on 2 o'clock. And very often people don't pay attention to it, but in periods like this, where up-to-date reports are important, that beige book is watched by the markets. And then we are going to get an addition, obviously, construction spending. We want to see that. We have some housing-related reports coming out in terms of prices. They've been, coming down, but basically holding up. But overall, what we want to see is construction spending, because the reason I watch that, and especially now, is hiring within construction. We want to see, does that hold up? So that there is a positive correlation with construction spending and jobs within the construction market. So we'll pay attention to that. And obviously on Friday, we're going to have a sense of construction hiring, and also with the ADP report. So this week's market is important for a variety of reasons. It's a short market week, but there's going to be an awful lot for the market to have to absorb. And the first one is, again, getting that debt ceiling passed in the Senate, in the Congress, and that is scheduled most likely for tomorrow. Now, last but not least, you thought that June 1st was the X date, right? When the market just has to deal with no more money. The Treasury Department has no more money. You may have seen last week that the X date was moved to the first week of June, toward the end of the first week of June. So that gives some breathing room to this whole exercise. Not much, but some. And again, the market's going to pay close attention to that. Overall, what we have is a market that is still being led by a handful of stocks in the big tech area. Also, what we're watching, and it's very important because we want to see a broader participation in the market. And most likely, what most of us are looking for is the small and mid-cap names. And the reason for that is twofold. One is that if we continue to see the small and mid-cap climbing higher and inching higher, and as I do this call, I see that the Russell 2000 is in the red, but it had been inching higher. What it does, what it expresses, and what it's a reflection of is a easing of concern regarding the bank situation, the regional banks and small banks, because they populate quite a bit of that sector. That would be positive for the market overall, to see the Russell climbing higher, inching higher, and follow through in that as the NASDAQ continues to make its moves. So again, we want to look for a broader market, and we had many analysts and those of us, in research, looking at perhaps a debt ceiling conclusion, positive conclusion, helping to underpin a broader move in the market, to give the market more breadth. So that's it. It's going to be an interesting week, short week, true, but an extremely important week, particularly now for the focus on the Fed. Remember, their rate meeting is June 14th. They meet the 13th and the 14th. On the 14th, they set the rate. This week there is Fed speak, and again, we want to see if there's any message that is being delivered. So far, a message that has kind of filtered through by the Federal Reserve speakers is maybe skipping this meeting coming up, not pausing, but skipping it and making a decision in the July meeting for the Fed on rate hikes or continued pause. So a lot for the market to absorb this week. Short week, but busy week. Thank you so much. Have a very good week. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.